So Steve, thank you for your time today. I really appreciate it. And I look forward to asking you some of these questions as some of our past clients, current clients keep asking. And it's time for me to bring an authority like you
Okay.
to really explain what it means to them in a way that they can understand, but also have somebody like you, an authority figure that's been in the business for a long time and processes multiple loans a month to answer some of those questions.
Yeah, no, I'm happy to be here. Appreciate the opportunity to share.
I know, of course. So the topic for today is going to be, what credit score do I need to buy a home?
Okay.
And some buyers are unaware of their credit. Some buyers are unaware of what credit score is needed to qualify for a mortgage. And some of the buyers are discouraged,
Right.
I would say, because they don't think they can. Some of the buyers are discouraged because they don't know how they're going to buy or can buy, or if they can actually get the real estate game and start doing that. What would you say to the first-time home buyers here in Orange County, Riverside, San Diego, or even your kids? They get out of college, just look for a job that, oh man, am I ever going to be able to buy a condo?
Yeah, it is tough. It's an uphill
Yeah.
battle just from a financial in general, let alone credit scores and all of that stuff.
Yeah.
As far as credit scores go, something that I always tell people, everybody comes to me and says, oh, I have a 750 FICO score. Everybody, and not to say anything bad, but there are different scoring models. If you go to apply for credit to buy a car, you're going to get a different FICO score than what your Credit Karma tells you or what your Capital One tells you. And if you go to apply for a mortgage, because we use a scoring model, they're not always the same. Sometimes it's higher, sometimes it's lower.
Okay.
You're going to be in the general ballpark,
Yeah.
but don't take that as an insult if our score comes in a little bit lower, because the algorithm that they use to score weighs different factors differently.
Got it.
So as far as FICO scores go, for an FHA loan, I would say the bare minimum that you need is going to be a 580 FICO score.
Oh, wow. Okay.
Yeah,
So that's lower than I thought.
We can do 580 FICO score with a 3.5% down.
Okay.
Now you are going to have to show that you have a strong credit history and all that. A lot of times people have a lower score just because their cards are maxed out. It's not because they have made late payments. They might have 2 or 3 cards that are pretty close to the limit, and it's going to affect your score drastically.
Yeah.
If you have a conventional product, you're going to want minimum 620.
Okay.
And you're with 620 and 580 for FHA, you're not going to get those rates that you see advertised on the windows of banks and stuff like that. Your rates are going to be higher. They're going to ask you for a lot more documentation and compensating factors.
Makes sense. The lower the credit, the higher the risk.
Yeah, and maybe some reserves that you wouldn't. Now, I personally haven't done sub 580, but you can get FHA loans approved down to 500, sometimes even with no FICO score. But they will ask you for at least 10% down.
Okay.
And they're going to ask you for reserves, and they're going to want to look at your payment history and all of that good stuff as well.
Okay.
The good thing about FICO scores is they're not set in stone, right? If you have a bad FICO score today, there's a lot of things that you can do to make it improve relatively quickly too.
No, to fix it. No, that makes sense. Thank you for explaining that in a way that most of us can understand, because you don't know. Oh, you're like me. I use Credit Karma, free app. I'm like, oh, I know what my credit score is. It's 840.
Yeah.
And then you go pull it because you got a car, like, oh, I thought it was 840.
Right. And it's different, right?
Yeah.
It's different every time you go, and every bureau that you use. Now some of our lenders now, one of the main lenders that I use, UWM, they're bringing out the option to use what's called a Vantage score, or your traditional FICO score.
Interesting.
And that just came out last month. So a Vantage score allows you to weigh things for people with limited credit history.
Okay.
Like maybe you rent, right?
Okay.
And rent doesn't show on your FICO score, but on your Vantage score, you can input those items. There was a program that came out recently, I forget what it was called, but you can input your cell phone bill and your gas bill and your utility bill. And if you pay those on time, it gives you a higher Vantage score. Might have a 680 Vantage score.
Okay.
And that, either way you qualify, but the difference between a 620 and a 680 interest rate wise can be tens of thousands of dollars over the life of the loan.
Yeah.
So you're going to get you're going to get way better terms with a higher FICO score or a Vantage score. Now the caveat with the Vantage score is we take what the middle Vantage score is, because you still have the 3 bureaus, and we subtract 20 points from it. And then that will be your Vantage score call versus the middle FICO score call. And we'll go with whichever one is the highest. So to be more beneficial to the borrower.
Yeah, that means that you can get somebody that has initially a 650 FICO score, going through the Vantage point. You can add some points and maybe end up at 720.
Exactly.
Which is a huge difference.
Yeah, and that could, not only does it save them money, but it might help them to qualify for more, because if you're tight on the debt to income ratio, you might be maxed out at 500,000
Yeah.
because you're at a rate that's 6.5%. But if you have that higher score,
Yeah.
you might get a rate that's 6.25, and that might give
Yeah.
you another $20,000 or $30,000 purchasing power.
Now you're buying a 2-bedroom condo.
Yeah, instead of a studio.
Yes, here, right?
Yeah, exactly.
Yeah, no, that's interesting. No,
Yeah.
that's awesome. Yeah,
Yeah.
I think there's not enough publicity, in my opinion, there's not enough publicity around education for things that matter, like financing a home, financing a car, or
Yeah.
credit, how to protect your credit, how to build your credit, and how to get in a position to actually save money monthly or over the life of a loan. And they don't teach you that in college.
No, 100%. And that's one thing that I like to do with our buyers
Yeah.
is educate them. We all get the same rates. We all
Yeah.
get, and depending on what people want to make on top of that,
Yeah.
we don't do it as a hobby. Everybody has a certain amount that they want to make.
Yeah.
But it's not just selling somebody a loan.
Yeah.
It's looking at their overall financial picture and finding what's going to best benefit them, whether it's in a refinance or a purchase.
Yeah.
Sometimes it's a lot more beneficial. Everybody thinks, I want to put 10% down or I want to put 20% down.
Yeah.
But a lot of times we can show them how to put 10% down,
Yeah.
buy down the interest rate, get a lower payment than they would have with 20% down.
Yeah.
And then they still get to keep thousands of dollars in their pocket.
That's huge.
To help offset payments.
Yeah.
Or do home improvements or anything like that. So it's not just about selling that product right off the bat. It's
Yeah.
about finding out what's best for the client, getting to know them a little bit, and,
Yeah.
and being an actual resource rather than just a salesman.
Yeah, I know that's huge. You basically hit the nail right on the head. It's being a resource to clients rather
Yeah.
than just a salesperson. And that takes in some ways, financial education, financial planning based on their goals.
Yeah.
Yeah, no, that's amazing. And one of the things that I mention all the time is you have to, in this market, because of how expensive everything is and because the rates are at 6.5 or higher,
Yeah.
is you have to figure out how to get into the game, into the real estate game, but you have to learn how to engineer equity into a property. So don't go for the new construction because that's going to be expensive, but find something that has your needs and you can make it your own.
Yeah.
Yes, you're going to have to put some elbow grease into it. You may have to put some money into it, but then when you're done, you have something that your basis is lower, you have what you want in the unit, and you also didn't pay a premium for it.
Exactly.
So I think it's mindset that a lot of these people in their 20s and 30s need to learn is, okay, yeah, no, I can't afford that new construction for $1.8 million.
Yeah, put a little bit of love into it. Put some sweat equity into it, right? Save everybody better.
Yeah, this is time to use the creativity and actually make it your own. Not only that, in the process, what I found is you can actually make money on it. So you're gonna build equity because not everyone's flocking to buy that property that needs lipstick.
Right. You take the ugly one, you buy the neighborhood, not the house. I mean, that's how
100%.
we've always done it. We've always bought houses that we could fix up and put something into and make them our own.
Yeah.
And
Smart.
in the process, you're putting money in your piggy bank, right? You're building equity. And that's the quickest, easiest way to build equity
Yeah.
is do some improvements on a piece of junk.
Not only that, you don't give the government any money from that equity
That-
unless you touch it.
Exactly.
But you
Exactly.
can keep rolling it and then you don't have to pay a dime on it.
Yeah, that's true. It's 100% true.
So yeah, I know it's awesome. Some of the questions that I ask my first-time home buyers and first-time investors is, can you, in modeling how much they can afford for an investment or for a home, it's okay. We start doing the numbers and they're like, oh yeah, but you know what? I'm gonna do this instead. And I'm like, okay, so let's look at the market. I do a future valuation for that property based on the growth rate. And then, so at this growth rate, can you save another $100,000 in the next 12 months? No, I can't do that. Okay, this house that we're looking at right now, potentially at this rate is gonna grow by $100,000 in 12 months.
Yeah, where are you going to get that return?
Where are you gonna get that return? And can you save enough, or what do you need to make to save $100,000? I need to make another $200,000. So does it make sense to buy it now or buy it in 12 months? You're right. It's okay, let's just look at the math. It's like, it's not a declining market and there's no bubble coming here.
No, that's true. And that's the unique thing about where we are right now.
Yeah.
Is that, rates are a little bit high, and I was going to elaborate on that too.
Yeah.
Sometimes right now, people can realize that if you buy, and nobody can predict what the future holds, right?
Yeah.
What we anticipate, we're anticipating rates pulling back a little bit. What's going to happen? Rates pull back. More people are going to come to the market.
Yeah.
Prices are going to go up.
Yeah.
So you buy now, you take a little hit on the interest rate.
Yeah.
And then you reap the rewards of that equity when rates do trend down and more people are flooding the market.
Yeah.
And there's more demand. So your equity position is going to go up doing nothing, just
Yeah.
for buying at the right time, what a lot of people consider right now being the wrong time.
Yeah.
But if you look at and I'm sure you do, the last couple weeks or the last month, like home purchase applications have been up,
Yeah.
regardless of the rates climbing, which they have been in the last month or so.
See, so the absorption rate has gone up in the last 2 weeks. We see it, and it's a good sign. That means confidence is back for the market, but also one of the things that I see is it's not just the confidence, but we're going into summer. The summer is a peak of our market,
Yeah.
from what I've seen, but also the confidence in the public is actually better because of policy and other things that are happening, which is really good. But also the people that are sitting on the sidelines are not going to have anything to refinance when everything drops.
Exactly.
So they're still going to be on the sidelines.
Exactly, right? And it's going to be that much harder to get into the game. Yeah.
Because now you're going to be competing with 10, 15 offers
Yeah,
again.
and you're going to have to come in with more money. You're going to have a higher house payment. Like,
Yeah.
the rates go down, but the price goes up. You're still at a net zero, right?
Yeah. So what would you say to those folks, like first-time home buyers or people that are sitting on the sidelines, to wait for the rates to come back to 4.5%?
It's not going to come back to 4. We might
Right.
get, if we're lucky, in the next couple of years, we might get to the high 4s.
Yeah.
Like for FHA, conventional, maybe low to mid 5s.
Yeah.
Which would be great. And and the problem is that people got spoiled in the early 2020s
Yeah.
with the 3% interest rate. I mean,
22,
I
yeah.
did one of my friends, the lowest rate that I did, 1.875.
What?
Fixed rate, yeah. It was a refi. So at that rate, it doesn't even benefit you to pay off your home, because
Why would you ever pay that off?
right? Just make the minimum payment and let it sit.
Yeah.
But people's mentality is that they think that it's not going to be a good time to buy until we're back in the 3s. That
Yeah.
was like a once in a lifetime shot right there. I'm not saying it won't ever happen again, but if it does, there's going to be a lot of other financial stuff going on to
Yeah.
create that situation, right? God willing, not another pandemic or anything like that. But historically speaking, where we are is still good rates.
Yeah.
If you take the historical average of what interest rates are,
Yeah.
where we are right now is still a good rate.
Yeah.
And especially for people who are in a position where they have a lot of credit card debt and stuff like that, being able to roll that in to a 30-year fixed rate in the 6s or 7s, as
Right.
opposed to paying 23% or whatever or more your
Right.
credit card.
Yeah.
It's a great way to leverage. And as I'm sure you know, right now, the United States has more equity than we ever have as a whole, right? Not
In a
everybody.
while, right?
Yeah, yeah. But no, historically, it's the highest equity position that we've ever been in as a country.
Wow. That's
so,
amazing.
yeah.
That's really
it's
good
a
news.
Great time to buy, to refi, all that good stuff.
Yeah, no, that makes sense. Thank you for highlighting that. Yeah, it's really interesting. We're at a very unique place in history.
Yeah, and the market is not working like we're accustomed to either, which is a whole other thing in itself, because
Yeah.
normally when the market's not going or working how it's supposed to, it's a bad sign. Right?
Yeah.
But right now, it doesn't appear to be. It seems the market's still we're not getting those 15% appreciations that we were, but still
That was
steady,
crazy.
Yeah, a steady 3% appreciation
Yeah.
over when you have hundreds of thousands of dollars wrapped up.
Yeah.
That's a good return on your money.
Oh, yeah.
Yeah.
It's
And a
huge.
secure return.
Yeah, right. Secure return. Yeah. Is that SpaceX?
Yeah. Hey, that went public today.
I know, yeah. So, yeah, IPOs, yeah. On this one, I want to sit on the sidelines. It's probably a bad idea, but IPOs normally scare me.
Yeah, you never know what's going to happen. Could be overvalued.
Yeah, I would a couple of weeks and see how the train goes, and then go.
Hop on if it's time then.
Yeah. But yeah, no, thank you. So let's get into the next question, if it's possible.
Yeah.
Is there a magic credit score number that automatically gets someone approved for a mortgage?
No.
Yeah.
And people are always so wrapped up, like we were talking earlier
Yeah.
about the minimum. What's the lowest FICO score they can have? Okay, that's important, right? Because you want to be above that threshold.
Yeah.
But I've seen people with 780 FICO scores that weren't able to qualify just because their debt to income ratio.
Yeah.
And obviously it depends on being realistic about what you want to buy as well, right?
Right.
But if you're making $20,000 a month and you have $5,000 in debt and you want to buy $1 million house, it might not be that easy, right? But on the same token, I've seen people with a 620 FICO score that have very little debt be able to qualify easily.
Yeah.
So it's more than just a number is the best way to put it.
Yeah.
The FICO score is great. What the FICO score does is it establishes preferential terms for your interest rate and your loan, and maybe make a lot of the conditions easier or lighter.
Shows responsibility that you can pay
It
your
shows
bills.
responsibility. You can pay your bills. The length of your credit history is something that's important also. How many bills do you pay on time? How long have you been paying them on time? If you have one credit card, it's hard to get that 800 FICO score with only one card because there's no depth of credit.
That makes sense.
So you might be really responsible and you might think that, hey, I want to pay everything cash.
Yeah.
But even with my kids, the first thing when they turn 18, I feel like a bad parent saying it, but you need to open a couple credit cards. Not to use them, be responsible with them, but you want to start that credit history from then and make it last as long as you can.
Yeah.
So just get a cheap credit card, don't use it, put gas in it,
Yeah.
or put gas in your car with it and pay it off every month.
Yeah.
And that's going to help you build that score and show that depth of credit history that we need.
Yeah.
So Scores are important, but there is no magic number that will qualify somebody.
Okay. Thank you for addressing that. I know some people think that, but it doesn't really exist. There's multiple things.
Yeah.
Another question I have for you today is, what's the lowest credit score that you've personally seen someone get approved with? And what were the conditions, if you can share?
Yeah, so like I said, 580 was the lowest that I've done.
Okay.
It was an FHA loan. We did have to write a bunch of letters of explanation regarding why they were there, why they were in a position to buy with a FICO score like that.
Okay.
They did want to see reserves. They did want, we were able to get the 3.5% down payment, but we had to show income, employment, credit, all of that good stuff. And they really dug through it with a fine tooth comb. So it does make things harder, but that's the lowest. Like I said before, it can be done under 580. I personally haven't done one under 580, but it can be. It's just, you're gonna have to put a bigger down payment down. And then there's always the non-QM world, right? Where FICO score is just a number, it doesn't really matter. And it's and in a lot of those products, it's based on the property. Once you get into hard money and stuff like that, based more on the property. And a lot of times they'll look at your credit and just make sure that you haven't been involved in any fraud or anything like that. And as long as maybe you just missed a few bills, you can still fly through, but that's a whole other animal, so to speak. That's not, your normal first-time buyer that's worried about their FICO score isn't going to be looking at stuff like that.
Got it. No, and that's helpful to understand too, because it just, everyone's different. And sometimes what people see in social media or what their friend tells them or the plumber tells them is completely different than
trust me, I've heard it all.
So no, thank you for that. Another question we have is, most people know credit score matters, but what other credit factors does the lender actually look at that most buyers don't think about?
Most importantly, debt to income ratio, right? They're going to look at
how
what
much
you make
versus
and
what
you owe, not just the house you're buying, but all of your debts.
Everything on your credit, right?
Yeah, everything on your credit is important. Job history, they want to make sure that you've been in the same line of work and employed for at least 2 years. So we want to show that stuff. And sometimes even just having a 2-month gap in employment. Say you quit one job because you were going to start another job and then it was longer than 2 months. That can create a big heartache for us. Letters, we're going to have to really kind of dig into our bag of tricks and provide extra documentation for the underwriters. Just because, and some people just wanted, hey, I got a good job coming up. I have a severance here. I don't need to rush into another job. But we're going to have to explain that gap and have a valid reason for that gap.
Yeah, that makes sense. Because I've had friends that get a severance for a full year. And then they take a few months off. Oh, I'm doing this and stuff. But it's interesting that you say that, because you're right. I never thought of it that way. But to qualify for a mortgage or refinance, that's going to be tough, and you're going to have to do a lot of explaining why you sat on the couch for 3 months.
And it's not, those are hurdles that we can overcome, but it just makes the process that much harder, right? That, what else would there be? Self-employed people, we want to make sure that they've been self-employed for at least 2 years. No declining income. So all of these things, there's a lot of different things that they look at. No, and that makes sense. One of the things that I started seeing, and I don't know if it's every company, but I started seeing employment being listed on the credit report. Yes.
Is that a new thing or no?
It depends. It depends who you work for and if they report it to the credit bureaus. Yeah.
Interesting.
So there are other products, and there are reasons you can actually have that frozen from your credit report, right? If you don't want to share that. A lot of times it's a good thing to do, because then sometimes the underwriter will look at that and see that you've jumped around from different jobs. And depending on the underwriter, we have no control over the underwriter.
And they're still humans, right?
And they're still humans.
AI.
Yeah, and they might be having a bad day. And they might say, this guy's jumped all around and all that stuff. So maybe it's better if you can just have that removed from your credit report. So you can actually contact the credit bureaus and ask to have that.
Okay, that's good to know. I did not know that. Quick tip, we'll put it in the description so then they can contact them and get it removed if they don't want it on the credit report.
Yeah, you put a freeze on it.
Yeah, no, that's awesome. All right, so another question. If someone's watching this video specifically, has a 580 or 600 FICO score right now and wants to buy in the next 12 months, what's the fastest and legitimate way to raise their credit score?
Pay your bills on time. Obviously, that's not fast, but that's number one important, right?
Okay. That was the most.
Don't start slacking. If you want to buy in the next year, don't start slacking on paying your bills. Pay them on time.
Okay.
The fastest, most legitimate way to boost up your FICO score, and I've seen people increase their score by 60 and 70 points, being added as an authorized user to somebody's credit card account.
Okay.
So say you have a spouse or your parents and I've done this for my kids as well, put them on my Nordstrom card, right?
Yeah.
So you put them on a card that has a high balance
Okay.
with a low usage
Okay.
and a long history.
Okay.
So like the Nordstrom card, I had it for 20 years, right?
Mm-hmm.
So when my kids turn 16, 17, I'll add their name on there. They have a 20-year credit history, even though they're only 16 years
16
old.
years old, yeah,
So
that's
it's a way to
amazing.
kind
Yeah.
of trick the algorithm, so to speak, and you just get added on. You don't have to have access to the account or anything like
Yeah.
that. But if you do that, obviously, another thing you can do is just make sure there's no errors on your credit report. Go through your credit report. If there are any errors, write letters and
Yeah.
have those removed.
Yeah.
And that can increase your score relatively quickly.
Okay.
You also want to go through and any little collections, like deal killers, right? And I think that
Medical
might be
collections.
medical collection, stuff like
yeah.
that. Stuff that people don't think about.
Yeah.
You canceled your AT&T satellite thing and forgot to send back the equipment. And you just put it. That's happened to a number of my clients where,
Yeah.
oh my gosh, I didn't even know. And then there's a $300 collection that kills your deal.
Oh man, for not returning the box.
Yeah, just for not returning the box. And then they don't call you, they just ding you with it, right?
Okay.
So,
Yeah.
little stuff like that. So just stay on top of your credit.
Yeah.
But the best way to boost your credit is to find somebody with a long-term credit card
Okay.
and be added as an authorized user.
Okay.
If they have a card that's $10,000 limit and it's got $9,000 balance, that's going to hurt your credit. So don't be added to that. You want to add to a card that is just in the back of somebody's wallet. They
Yeah.
don't use it and it's got a nice limit
Okay.
and a low balance. And then you're
Okay.
good.
No, that's gonna. Thank you for that.
Yeah.
That makes a lot of sense. So, next question: what's the most surprising thing you've seen on someone's credit report that killed the deal, or something that people would never think to
Well,
change?
like we were just talking about, right?
Like the cable box
Yeah,
that you
don't
return.
return the cable box. We've run into hundreds of times medical collections that
Yeah, I've
people
seen
forget
that even
about.
for $45
Yeah,
or something.
little tiny things. You forgot to do a copay and they sent you, and you're just like, yeah, whatever. And so many people think that because it's $25 or $50, that it's not a big deal.
Yeah.
And it does wind. It is. It's not a big deal until it is.
Until you need your credit.
Exactly. Yeah. Just weird little collections like that are probably the weirdest thing that you would think. And it's the thing that you get the most pushback on because people they think it's not a big deal. And it really isn't. You should have just wrote the check for $50 or whatever the magic number is. And I've had a lot of deals that got killed because of a little tiny collection.
That's so unfortunate.
Yeah.
Yeah, and then they have to wait another year. Or wait
Yeah,
8
you got to
months.
resolve that one way or the other and then just go through it. Because a lot of times even paying off the collection, it's not going to instantly fix your credit, right?
Yeah.
It's there, so you just got to wait for it to get better.
Yeah.
And you can go through these credit repair places and all that stuff, but a lot of
Do they help? Because
if you get a good one, but there is, at the end of the day, there's only so much they can do. If it's a valid debt that they can't have removed,
Yeah.
it's going to be there.
Yeah.
There's nothing you can do about it.
That makes sense. So best policy is pay your bills on time.
Yeah.
And don't be late.
Exactly. Try your best.
Yeah, try your best. Makes sense. And all right, so next question. There's a rumor out there that having too many credit cards or even closing one can tank your credit score. Is any of that true when it comes down to a mortgage approval?
Having too many credit cards, no, unless you carry high balances on all of them, right?
Okay.
So that we get back to the debt to income ratio on that. So if you have a lot of credit cards, we're going to have to add up the minimum monthly payment on all those credit cards, and then against your income, add your new house payment into there, and then we have to be under 49% max for a conventional loan. On an FHA loan, we can go a little higher. I lost my train of thought. I'm sorry.
It's all good, yeah. No, I know we've been talking about a lot of stuff.
Yeah, what was the question again?
Yeah, so in regards to having too many credit cards.
Okay, yeah. So having too many credit cards, not an issue as long as they're under control and within your budget.
Okay.
Closing a credit card, yes.
That dings.
That can ding your credit because especially, say it's a credit card that you've had for 15 or 20 years and it had a decent balance, it's going to take away from your available credit.
Okay.
And it's going to, you get extra points for having long-standing accounts, right? So if you have an account that's 10 years or more, it's really helping your credit.
Okay.
And if you close that account, it really hurts your credit.
I experienced that.
Yeah.
I had a Discover card that I had since I was like 17 or 16. It was my first credit card, I think.
Yeah.
And then 3 years ago, I'm like, I don't need it. I found it in my drawer. I have this, let me see if it's active. It turns out I still had money in it, like a credit. And then I'm like, okay, I'm just gonna cash it out and close it out.
Yeah.
And then I lost 17 points.
I would say 20 points. Yeah.
I got I got a pop up from Credit Karma saying, "Oh, your credit score went down 17 points." I'm like, "What the heck?"
Yeah. And talk about getting anxiety, right? Those credit emails that we get all the time, like every time your credit fluctuates, it gives you anxiety. And it is. I truly believe that it's unfair because You build a credit history, and then
Yeah.
there's a point where you really don't need it. It doesn't mean you're a bad person. It doesn't
Right.
mean that you're irresponsible. You just don't need that card anymore. And
Right.
and it sucks that you get penalized for it. But
Yeah.
you do. Yeah.
Yeah.
It's the cold hard truth of it.
Yeah, the algorithm.
Yeah.
doesn't really-
The algorithm.
That's
So
really
if you are going to close an account, wait till after you buy.
Okay. Yeah.
And then
Just
close away.
Cut the card.
Cut the
and
card.
be done.
Yeah, exactly. Cut it, and then just make sure nobody else is using it
Yeah.
that you don't know about. Because
Yeah.
then you're going to run into one of those scenarios where
Where
you
you
have a
have-
collection you didn't know about.
Yeah, the surprises later.
Yeah, exactly.
Yeah, no, that makes sense. So yeah, that concludes this episode.
All right.
So thank you for that. We'll
Yeah,
do
my
part
pleasure.
2 and then part 3 as we go along. So
Okay.
thank you everybody for tuning in. Stay tuned for episode 2.
All right. Thanks.
Yeah.